some thoughts and strategies and a little bit of education this evening, but you should go speak to your own personal tax and legal or investment advisors prior to implementing any of these strategies. You can see on the screen now some of the materials that the principals of OJM have created. These are mostly our materials for physicians. We do also have a book titled Wealth Secrets of the Affluent that's got some financial planning advice for non-physicians. At the end of the webinar, I will be letting you know how you can get these materials. You can notify the firm and we'll send those out to you. So what are we looking at right now under the 2013 tax law? It's due to be implemented January 1st. We're looking at changes in investment income for the taxation of capital gains, dividends, and passive income. As far as deductions and exemptions go, you're looking at a reduction to the marriage, or the reinstatement, I'm sorry, of the marriage penalty, and the itemized deduction and exemption phase out. In addition, you're looking for the estate tax exemption to be greatly reduced from the current. I'm sorry, I'm going to pause because someone's telling me they do not see the slides. So hopefully now you can see the slides and type in a question or let me know if you can't. So in addition to the deduction and exemption phase out, we're going to talk about some of President Obama's current budget proposals, including in his budget, he also wants that itemized deduction phase out. He wants to reset the top 2 tax rates for top bracket taxpayers back to the pre-Bush tax cut rates. He would like to see the dividends and capital gains tax rates increase to increase revenue, and he would like to limit the benefit of itemized deductions to 28%. So while you might be paying at a top tax rate of 39.6%, you might only receiving the benefit of the itemized deductions at a 28% tax rate. We're also going to discuss a little bit of how you might minimize the effect of these tax law changes. Some of those ways will be by accelerating income into 2012, planning for your retirement income, perhaps to keep you out of the brackets that are going to be subject to the new surtax under the Affordable Care Act. We'll talk about planning with Roth IRAs and Section 529 plans. And we'll talk a little bit about cash value life insurance and how that might help in your planning. So let's talk about investment income and what's going to happen with that. First, on capital gains and dividends. Long-term capital gains rates will increase from 15% to 20% on January 1st, 2013. In addition to that, for taxpayers at a higher income level, those capital gains will be subject to the 3.8% Medicare tax under the Health Care Reform Act, or Obamacare, making the total rate on long-term capital gains 23.8%. Dividends. Under current law, since the Bush tax cuts, we've had what's called a qualified dividend rate. Qualified dividends are most dividends from U.S. corporations, and they have been taxed at a top rate of 15%, or the same as the long-term capital gains tax rates. Effective January 1st, 2013, those dividends will go back to being taxed at ordinary income tax rates. So if you're in the top tax bracket, you might be paying tax on your dividends at 39.6%. In addition, the 3.8% surtax will also apply to dividend income. So dividends on U.S. stocks go from being taxed at 15% on December 31st to a potential total of 43.4% on January 1st, 2013 for taxpayers in that top tax bracket. So tax-free investments certainly will become more attractive under the new law as the rates on those taxable dividends go up. Passive income has some changes in effect too. So in order to help pay for the new Health Care Reform Act, a 3.8% surtax goes into effect on all passive income. That includes interest income, rental income, annuities, royalties, and flow-through income from activities without material participation. That means if you're a partner in a partnership where you're just an investor, not an active participant, or a shareholder in an S corporation, again, passive activity where you're not an active shareholder, maybe it's not your main business, that income from those entities, if you're a high income taxpayer, will now be subject to the 3.8% surtax. So who is affected by that 3.8% surtax? If you're a single taxpayer, you will be subject to the surtax for modified adjusted gross income over $200,000. Married taxpayers who file jointly will be affected if their modified adjusted gross income is over $250,000. So consider these things, and I think this becomes pretty pertinent. The top ordinary tax rate will go from 35% to 43.4% on some of these income items. So income items that are subject to the surtax. That's a 24% increase. The top capital gains rate will go from 15% to a total of 23.8% for taxpayers in the top brackets, a 58.6% bump. And the top dividend rate on qualified dividends goes from 15% up to 43.4%. Again, for taxpayers in the top bracket. That's a 289% jump in the tax rate on dividend income. In addition, the estate tax exemption, which is currently at $5.1 million, will be reduced to $1 million, and the tax rate increases from its current 35% up to 55%. This is a 57% jump. So while we're hearing a lot about this 4.6% increase in the top ordinary income tax rate, we really need to appreciate what the percentage increases truly are when we're looking at the changes in the tax code. So let's talk a little bit about what's happening with deductions and exemptions under the law as it exists today. The marriage penalty comes back into play. What the marriage penalty is, in its simplest terms, is two taxpayers who would file single tax returns with the same amount of income as a married filing joint tax return would pay less tax on their two single returns than that married filing joint tax return would pay. So effective, called the marriage penalty. You know, your tax advisor might tell you that you're better off remaining single, filing two single tax returns versus filing married filing joint. And unfortunately, once you're married, your choices are you can either file a married filing joint tax return or you can file married filing separately. Relief went in to sort of fix this problem, but that marriage penalty relief expires December 31st, 2012. So in addition to that, there is a reduced 2013 standard deduction amount. Again, the standard deduction, which is what you'd take if you do not itemize your deductions, goes down next year. there are lower tax bracket thresholds in the rate tables as well. So that means couples move into a higher rate bracket at a lower income level. The exemption and itemized deduction phase out. Itemized deductions for high income taxpayers will again be reduced by 3% of the amount that adjusted gross income exceeds a threshold. So again, we're going back to the rules of the pre-Bush tax cuts, where higher income taxpayers, if your AGI is over a certain threshold amount, you're going to calculate all of your itemized deductions on Schedule A of your tax return, and then there will be a reduction in those by 3% if you have a certain AGI level. So up to a maximum of 80% of your itemized deductions could go away in this manner. You're also going to have personal exemptions phased out again. This is the way it was in the pre-Bush tax cuts. We have been able to enjoy the use of personal exemptions for all taxpayers over the last several years, but that will no longer be the case in 2013. The estate tax exemption is also getting a lot of press. As you know, back in 2010, there was an extender that was put into place in December that created a $5 million exemption amount for an estate, $10 million for a married couple, and one spouse's unused exemption could flow to the other spouse. So as of today, that estate tax exemption is set to go back to its pre-Bush level of $1 million on January 1st, 2013. And again, the estate tax rate is going to jump from 35% back to 55%. So if you are in the mode of doing some estate planning, while the exemption amount is over $10 million right now, it's a good time to set up trusts or do gifting at those bigger lifetime exemption amounts. Now, lots of people aren't quite ready to do that for purposes of, maybe you're young, you're not quite ready to give up control of your assets that you might have to do in estate planning. But it is a good time to go talk to your estate planning attorney and talk about where you are, what's the size of your estate, does it make sense to do some estate planning now before the rates are set to go up and the exemption amount is set to reduce quite drastically. Obviously, if the estate tax exemption amount drops from $5 million to $1 million, it makes a lot more people subject to the federal estate tax. A lifetime gift exemption will also revert back to $1 million. It was increased to the $5 million to equal the estate tax exemption, but that will also $1 million on January 1st. So as far as the budget proposals that President Obama is looking at right now, the not so good news, again, a cap on itemized deductions. What this would do is limit the value of the itemized deduction to a maximum benefit of 28%. So again, you're not going to get a dollar for dollar reduction for those itemized deductions that you have. This would affect, under the current proposals, taxpayers, single taxpayers with $200,000 of adjusted gross income and married taxpayers with $250,000 of adjusted gross income. In effect, what does this do? It reduces your tax savings for your mortgage interest, your charitable deductions, deductible medical expenses, real estate taxes, and state and local income taxes. Those are your items. You're going to get a maximum benefit of 28% on those. And that's going to apply to the top 2% of taxpayers under the proposals. So what's some better news? As I said at the beginning, certainly there's still a chance of a compromise over the next 3 weeks. recent talks and a lot of press suggest that tax rates will go up. However, perhaps the top rate will be 37 or 38% versus that 39.6% that we're looking at as of today. There's also been some talk that a compromise might include the definition of wealthy moving to $375,000 versus that $250,000 level, or even up to as much as $500,000. Again, it's all a lot of conjecture, and no one, I guess, knows what's going on behind closed doors when President Obama and Speaker Boehner are talking. There's also some talk that maybe the top dividend rate will only go to 23.8% versus 43.4%. What this means is that there's a chance that the qualified dividend would still stay in effect. It would be taxed at the capital gains tax rate, which is going to 20%, plus the 3.8% Medicare surtax amount. Cuts on health care and retirement spending are certainly where they're focusing as part of the compromise in the spending category. You know, obviously for the fiscal cliff, I think President Obama has dropped his requested revenue increase amount by a little bit. And I think Speaker Boehner has said they're willing to increase their revenue increase by a certain amount, but they're still pretty far apart. I think I saw they're still about $800 million apart today. So in order to minimize the effect, what can you do? You know, in the next 3 weeks, what's the possibility? If you've got the ability to realize a large capital gain, you know, if you're selling a business and there's a deal on the table, selling investment property, selling stocks, realizing large capital gains in 2012 versus 2013 certainly makes some sense right now. If you have the opportunity to take a bonus now at the end of 2012 versus receiving it early in 2013, definitely receive it in 2012 and have it taxed at the lower tax rates. Cash basis taxpayers, normally what we CPAs tell people is to try to speed up the payment of expenses at the end of the year so that they're deductible in this tax year. Obviously in 2012, if you're in the top tax bracket, you're getting a 35% benefit for those cash expenses that you're paying, whereas in 2013 you're going to get a 39.6% benefit potentially. So push those expenses this year and pay them in January 2013 rather than in December. Another thing that's going to make sense, certainly in 2013, is utilizing installment sales to spread your income. This will absolutely make sense for people who are on the threshold of being subject to the surtax. If there are ways to minimize your income or spread your income over several years in order to stay out of that surtax threshold, that's going to be a good thing. For retirement planning, this is a great year to convert your traditional IRA to a Roth IRA. Again, tax rates are lower. They're set to go up next year. So on a Roth conversion, you will pay tax at ordinary income tax rates on the value of your account at the date of conversion. So any monies that have not previously been taxed will be subject to tax on a conversion. If you can do that at lower tax rates, that's good. And while a Roth conversion is not subject to the Medicare surtax next year, it will again bump up your income above those potential threshold amounts to make your other investment income and passive income subject to that surtax. So it makes sense to do the Roth conversion in 2012 if you're thinking about doing one. It's also going to be very important to plan for pension and retirement income as you're receiving it in order to help keep the threshold. how can you do that? Again, another reason that it makes sense to do a Roth IRA conversion is that there's no required minimum distribution out of a Roth IRA. In a traditional IRA, you've got a required minimum distribution amount once you reach age 70 and a half. That money will have to start being distributed and will be taxable to you whether you need the money or not. Whereas a Roth IRA has no required minimum distribution, so you can allow it to accumulate if it's not needed and then not have that income stream. You're going to want to maximize the use of high deductible retirement plans, defined benefit plans, and deferred comp in 2013. Again, as rates go higher, those qualified plans that get a full deduction, you're getting more bang for your dollar by getting the deduction in higher tax rate. Deferring compensation makes sense. What we don't know certainly is how much higher could tax rates go. So the only problem with the high deductible plans and deferring your compensation is certainly with the deficit the way it is, with the economy the way it is, I guess there's a chance that rates will go up even higher in future years, and those retirement plan distributions or deferred compensation will be subject to tax in later years when you receive them. A hybrid non-qualified plan might make sense for you. A hybrid plan has some of the elements of a qualified retirement plan, but other elements of a non-qualified plan. It's a great idea for some people because you do get the tax deduction today. You get tax-deferred growth within the plan, and the distributions can be tax-free in retirement. So again, it's nice to get that tax deduction today, but not having to worry about the higher potential of tax rates in the future. Captive insurance companies are a great planning tool for certain taxpayers. A captive insurance company allows you to own an insurance company, a valid insurance company licensed in a state by a state Department of Insurance, and that insurance company that you own can cover your currently uninsured or underinsured risk. Your business will deduct the premiums paid to the insurance company as ordinary and necessary business expenses. And under Code Section 831B, the Internal Revenue Code, the premium revenue that the captive receives can be tax favorable. So a captive insurance company can receive up to $1.2 million of premium revenue each year tax-free. Now, a captive insurance company is not going to be meant for everyone. We generally tell our clients, we don't even really think about it with clients unless they've got a business that has $3 to $5 million of gross revenue and good cash flow, and an actuary would then look at the risk and examine the risks of the business and see if there are holes where you might be underinsured. If so, a captive insurance company can make sense and can be a great tax planning tool as well as a tool to help reduce the risk in your business. 529s and tax-free investments are also certainly worthy of more looks now that tax rates are going up. 529 plans, which are the educational savings plans that allow you to contribute after-tax dollars into a plan for a beneficiary. The money grows on a tax-deferred basis, and once you receive money from the plan or it gets distributed, as long as that money is used to pay for qualified higher education expenses, it's not taxed as it's being distributed. So effectively, you've received the growth on the account on a tax-free basis. Again, Roth conversions with no required minimum distribution are a plus. Municipal interest becomes more attractive as it doesn't add to that modified adjusted gross income that would again push you over the threshold and into being subject to the surtax. So you're going to want to look at municipal interest more closely as part of your investment portfolio. Cash value life insurance will also be beneficial. The investment growth is not subject to either income tax or the surtax. Index products have downside protection. So in a lot of cash value life insurance policies, an indexed product, they might be tied to something like the S&P 500. In a lot of the policies, if the S&P drops, the policy will have a 0% floor, so your basis stays safe in those down years of the stock market. Cash value can then be accessed on a tax-free basis when you want to take money out of the cash value of the policy. So, how can OJM Group help you in looking at the fiscal cliff and thinking about what you're going to do, or I guess how you're going to survive the cliff? OJM Group has a multidisciplinary team of experts. There's a focused approach to tax planning, retirement, and insurance planning, as well as asset protection. And OJM also has investment professionals to advise you on investment income with an eye towards taxes. So we're going to do a quick poll question for the participants. If you don't mind answering the question. So the poll question is, what is the next best step for you? If you'd like a free copy of our book, either For Doctors Only or Wealth Secrets of the Affluent, if you'd like to schedule a free consultation with one of OJM's advisors, maybe you want to be added to the newsletter, or all of the above. You can check as many boxes on the poll as you would like. Okay, we're going to close that poll, and thank you for your answers. So if you need more information, I'm going to look. I don't see any additional questions, so I think we're good. But for more information or to set up a consultation or to request one of the books, please contact Kathy Allard at OJM's offices. The toll-free number is on the screen, 877-656-4362, or you can email Kathy with a K, at ojmgroup.com. We certainly appreciate your attendance this evening for the webinar, and again, apologize for our technical difficulties at the beginning. We really do appreciate your time and attendance this evening. So thank you very much for joining us, and I hope you all have a great evening.